1. Start with energy, explain with authority, highlight with emphasis, end with warmth. Current market action on this Monday morning sees PACS Group Inc. trading at precisely $29.04. That is a green ticker, up $1.53, translating to a robust gain of 5.58% on the session. It is 10:14 a.m. Eastern Standard Time. If you are just tuning in or glancing at your watch list, you might assume this is just another volatility spike in the healthcare sector. The expectation for a skilled nursing facility operator is usually low beta, slow movements, and boring dividends. But the reality of what we are witnessing at this $29 level is the violent repricing of a company that has just emerged from a near-death experience. This isn't just a stock going up, this is a clearing event unfolding in real time. The market expected PACS Group to be buried under the weight of regulatory scrutiny and short seller allegations from late last year. The reality is that the company has not only survived, but has just delivered a financial rebuttal that is forcing every short seller to cover their positions at a massive loss. This 5% move is the sound of skepticism leaving the building. When you look at the tape this morning, the volume is telling a very specific story. We are seeing aggressive buying on the offer. This isn't retail traders tentatively dipping a toe in. This is institutional capitulation on the short side and institutional accumulation on the long side. At $29.04, PACS is breaking through a psychological resistance level that has held it down for months. The expectation was that the Hindenburg overhang, the fear generated by the short report alleging Medicare fraud, would keep a permanent discount on this equity. The reality, confirmed by the recent completion of their internal audit and the reinstatement of their financials, is that the business engine is intact. Investors who are engaging in online investment strategies and filtering for turnaround plays are finding PACS at the top of their screens today because the fundamental thesis has shifted from risk of insolvency to return to growth. It is critical to contextualize this price against the broader market peers. If you look at the Ensign Group, the gold standard in this space, it trades at a premium multiple. PACS Group, for a long time, traded in the shadow of that valuation. But today's move suggests the gap is closing. The market is starting to realize that PACS's decentralized operating model is not just a buzzword, it is a margin expansion machine that rivals even the best players in the industry. While many are distracted by the flashiness of Nvidia stock or the consumer ecosystem of Apple stock, the smart money knows that the unglamorous business of post-acute care is where the demographic inevitability of the silver tsunami meets hard asset value. At $29, you are buying into a demographic wave that does not care about interest rates or tech cycles. People get old. They need care, and PACS provides it more efficiently than almost anyone else. Let's talk about the specific intraday dynamics for those of you using a Fidelity trading platform or monitoring via the Fidelity mobile app. The order flow indicates that the buyers are stepping up at every micro dip. We saw a brief pullback to 28.80 earlier in the opening 15 minutes, and it was bought up instantly. This buy-the-dip behavior is a hallmark of a stock that has changed its trend. For months, the trend was sell the rip. Now the psychology has flipped. The expectation is that any regulatory news will be bad. The reality is that the regulatory environment is actually shifting in their favor. With the recent political changes in 2025 suggesting the death of the federal staffing mandate, a massive cost overhang has effectively been removed from the equation. This policy shift is a massive tailwind that the market is only just beginning to price into the stock at $29. We must dig into the business model, because that is where the expectation versus reality gap is widest. The expectation is that a nursing home chain is a centralized bureaucracy where decisions are made in a boardroom in Utah. The reality of PACS Group is that they treat every single facility administrator like a local CEO. They give them equity. They give them autonomy. They say, "This is your business, you run it." This alignment of incentives is why PACS has been able to turn around distressed assets so quickly. When they acquire a failing facility, they don't just slap a new sign on it, they install a motivated leader who has skin in the game. This is why their occupancy rates are recovering faster than the industry average. While competitors are struggling with labor shortages, PACS administrators are hustling to recruit because their personal net worth depends on it. This human capital strategy is an intangible asset that you won't find on the balance sheet, but it is the primary driver of the earnings surprise we just saw. For the individual investor engaging in self-investing, the narrative here is complex. You have to separate the noise of the past 6 months from the signal of the current financials. If you rely solely on headline scanning from Robinhood news feeds or SoFi investing summaries, you might still think this is a troubled company. You might see the old headlines about the DOJ or the short report. But if you dig deeper, using tools like the Interactive Brokers platform to analyze the actual filings, you see that the company has addressed these issues head-on. The completion of the internal investigation without a material restatement of historical accounting recognition principles is a massive win. It validates their accounting. It validates their revenue. It means the cash is real, and in a market that is terrified of accounting irregularities, proven real is worth a premium. Let's look at the technicals on the chart. The stock is approaching the $30 level. $30 is not just a round number, it is a liquidity pocket. There are likely thousands of sell orders sitting there from bag holders who bought higher and just want to get out at break even. If PACS can punch through $30 with volume, we could see a blue sky breakout where the next resistance is not until the mid-30s. For traders using Interactive Brokers stock trading algorithms, this setup, a post-earnings drift that turns into a breakout, is a classic momentum ignition pattern. The Relative Strength Index, or RSI, is heating up, but it is not yet overbought on the weekly time frame. This suggests there is still fuel in the tank. I want to pause here and get a pulse on the sentiment from you guys. This stock has been a battleground. Comment below how many shares of PACS Group you currently hold, and more importantly, did you hold through the drop last year? I want to know if you possess the iron stomach required to ride out a short report, or if you are new to the name, buying this recovery strength. Your psychological state as a holder tells us a lot about the potential selling pressure ahead. Returning to the intraday action, the sector rotation we are seeing today is also favorable. Money is moving out of high-flying software names and into real economy stocks. Healthcare real estate and operations are beneficiaries of this rotation. When you look at your Schwab Intelligent portfolios or similar automated allocations, you will often see healthcare weighting increase as a defensive measure. But PACS is not just defensive, it is aggressive growth masked as defense. They are acquiring facilities at a rapid clip. The fragmented nature of the skilled nursing industry means there are thousands of mom-and-pop facilities that are struggling with compliance and billing. PACS is the consolidator. They are the Pac-Man of the industry, no pun intended. They eat the small players, plug them into their PACS back-office system, and immediately improve cash flow. The expectation is that integration is hard and risky. The reality is that PACS has turned integration into a science. Let's address the Tesla stock controversy in terms of controversy. Tesla was the most shorted stock in history for a long time because people didn't believe the production numbers. PACS faces a similar skepticism regarding its billing practices. The high acuity mix, taking care of sicker patients who pay more, was flagged as suspicious. But the reality of the 2025 healthcare landscape is that hospitals need to discharge sicker patients sooner to clear beds. They need SNFs like PACS to take these high acuity cases. The trend isn't fraud, the trend is the evolution of the healthcare continuum. PACS positioned itself to take the patients that others couldn't handle. That is a strategic moat, not a regulatory loophole. Understanding this nuance is the difference between selling at 20 and buying at 29. If you are using a Fidelity brokerage account, you might have access to the institutional ownership data. Look who is buying. We are seeing names like Cohen & Steers and Vanguard increasing their positions. These are not day traders. These are massive real estate and index players. When they step in, they put a floor under the stock. The smart money waited for the audit to clear, and now they are allocating. This institutional sponsorship is crucial because it absorbs the liquidity from the retail traders who are exiting. It stabilizes the volatility. The self-investing crowd often gets scared by legal jargon. Subpoena, investigation, audit. These words induce panic. But in the healthcare sector, specific